Cheers. Hi, guys. Thank you very much. All right. Good to know. So I've got to say we're using a new platform today, so there's always a little bit of teething issues. But look, I just want to firstly say, look, thank you very, very much for joining us, and welcome to this live webinar brought to you by CoreLogic New Zealand. My name is Nick Goodall, and I'm Head of Research at CoreLogic. And today I'm joined by our Chief Economist, Calvin Davidson, down in Christchurch, to talk about what's next for the regional property markets. I think there'll be a lot of interest in this one. Calvin, first up, thanks for taking your time to help us out to launch this Property Vulnerability Index today. But anyway, how are you going anyway? I'm going to go check Calvin's connection. You there, mate? Looks like Calvin may be having some troubles here. I'm going to kick off then. We'll bring Calvin in shortly. So Calvin, hopefully you can hear me, and once you can get into it properly, then we'll carry on anyway. But look, firstly, like I said, just want to welcome you all along, and personally, just want to say I'm really excited to get this report out there. It's been a bit of a labour of love for me over the last couple of months, and I think the report's looking great to get the support of our marketing design team, and I think that the insights will be really useful for a number of people within the industry. So I'm really excited and proud to put this one out there. Before I do kick into the actual report and the webinar today, I suppose it's always good to tick off a few of the old housekeeping issues. And so really want to say, just have a play with all the settings. It's all customizable, and if you're in doubt with your connection, please do shut everything else down on your computer, so you've only got this page live with the webinar and everything that's going on. So we're very keen to get a bit of interaction here going. We'll certainly have time at the end of today. So do get your questions into the Q&A chat box and within the On24 platform here. Hopefully we get to all of them, but if we don't, we promise that we will follow up afterwards via email as well. So please do fire through those questions as we're going through today, and we'll be sure to check all that later on. And do feel free to screenshot this particular slides that are interesting to you. Of course, the full report will be shared following the event, as well as a full recording of today's session as well. So you won't need to take those, but if there is something that you want right there and then please do feel free to get a picture of that. So now, before we kick into things, I thought it'd be quite nice just to get a feel from where you're all dialing in from. So I just set up a little bit of a poll here. So if you can jump in here at the moment and just tell us which region you are dialing in from. I'll give you a few seconds to answer this one, and then we'll see if we can check out those results. Looking good. Almost half people have submitted something there. We'll wait for a few more to get a view of what's going on. Trustly one for me too. It's one of those things, we've got a new tool and you can't help but want to have a bit of a play with things. So we had to chuck an option in there to see how the polling tool works in here as well. So we've certainly got amongst that now. I'm going to call it there anyway and just see where we've got everyone dialing in from. So look, 38% of people dialing in from Auckland. So, firstly, just want to say thank you to all of you who are obviously doing the hard work up in Auckland and the tougher lockdown restrictions and doing that work for us. So hopefully we do get some better news in the coming week. And thanks for taking one for the team. And that's probably pretty representative of our population, actually, sitting around 38%. So pretty representative. Good number from here in Wellington as well, which is obviously where I'm dialing in from. And then what have we got for Christchurch, Canterbury down south, where Calvin is? A good 13% too. So good representation from the main centres, but also good to see people dialing in from the smaller centres as well. But good to have you all from across the country, and we've certainly got lots to keep you involved and no doubt keep you interested in what's going on today. So look, I just want to cover firstly the plan for today. Very briefly, I'm going to set the scene of where the market's at today, and then we'll detail the vulnerability index, the reason that we're all logged in today. Firstly, we're going to spend some time working through the measures that we've used that we've created to try and understand what's going on. And those, because I think the results mean nothing without understanding the stuff that's underneath that. So we'll spend a bit of time looking at the measures we've created today, and then we'll go through the high-level results, as well as honing in on a few of the areas of most interest both because of the size of those areas or because of the results that we've seen from it. And then, of course, to close out, we'll talk about where to next with this index that we've created and answer any questions that have come up. So firstly, just to set the scene, look, I think that it's worthwhile recognising straight away that, we're in this period of the market slowing down. We're still seeing strong rate of growth, of course. That light blue line shows us that the annual rate of growth is very, very strong at the moment, upwards of 30%. But the blue line, the dark blue line, is showing us that quarterly rate of growth has been slowing down over the last wee while. And that's, I suppose, the key reason to really understand what's going on and dig into that a bit more deeper and understand where the market's likely to head to. And of course, when you see this market start to slow down, the key thing you start to see is divergence across the regions. So we're starting to see different parts of the country see some slow their rate of growth and some still actually seeing an extension or acceleration of the rate of growth. And often it's quite patchy. So month to month, we're seeing that quarterly rate of growth jump around a bit. And you can see that with a place like Hamilton, where at the end of August, we were talking about Hamilton's quarterly rate of growth drop into negatives. But then 1 month later, that quarterly rate of growth had jumped back up again. And I think this volatility is really a sign of the market when we're seeing the market not so strong. We're not seeing all properties sell really strong. We're seeing a bit of patchy performance. Some properties are selling really well, there's strong competition for, while other properties maybe aren't selling so well. And so that leads to that inconsistent performance as well. And that's really led us down this path to go, well, where are things at? And if we're going to see some vulnerability in the future, are there some areas that might see that more than others? And so that's where today comes in. And then, of course, when you're looking in the future, one of the things we've been looking at is, of course, the key influence of interest rates. We've now seen the first increase in the OCR for 7 years, and even prior to the OCR lifting last week, of course, we'd already started to see mortgage interest rates start to lift in the prior couple of months. So we're already in this environment of interest rates increasing, and we know that that's going to start to slow the rate of growth, and it already has done so, and that will continue throughout the rest of this year into next year. And then you look at that house price forecast from the Reserve Bank on the right-hand side there, you can see that dropping down to 0% by the end of next year and potentially even into negatives the year after that. Now, of course, this is a nationwide forecast, but our markets are so different beneath that. And so that's why we really want to tease out the difference here and say, well, just because the nationwide value growth is going to slow down and maybe push into negatives across the nationwide value, some areas will still grow, some will still grow quite strongly, and some may be in that -5 or so percent there. So that's really where we came to today, to try and put this webinar together, to put the index together, to understand how this is going to play out across the different parts of the country there. Now, I'm just going to try and, yes, I'll be sharing a recorded copy of the presentation afterwards if you need to. I just picked up on that question there. I'm just going to try and call in Calvin again. I know that I've seen a few messages pop up from him saying connection problems. Calvin, can I give you a second to see if you are logged in there properly and you can hear and present as well? Not looking good. All right, it might well be a solo effort for myself today there. I know that when we're talking about interest rates, one of the things that Calvin talked about quite a lot is that, we've seen that OCR lift by 0.25%, sitting at 0.5%. It's really trying to understand what does that mean from a mortgage interest rate perspective. And, we're talking about, by the end of next year into 2023, that mortgage interest rate might be upwards of 4, even 4.5%, which in the long-term history doesn't seem like a high amount, but it is proportionally high from where you're at currently today. So going from a 2.5 to 4% rate, that is quite a significant difference in the amount that people will be paying back in their mortgage. And I think that's the one thing we want to take note of and try and understand where that might cause more problems across the country than other areas, and really reflect in the fact that we think it's going to play out differently across the regions. And before we get into some of the detail, I think it's worth getting out in front. We're not putting a prediction out there to say one area is going to drop by 10%, one area is going to increase by 10%. It's all relative terms. And so we're just trying to get that feeling for what might be worse off and what might be at the more robust end of the scale as well. So we're certainly not saying one area is going to drop significantly while another area continues to perform well. It's all relative, one slightly better than others. And we'll tease out some of that detail as I go through today's presentation as well. Now, to do all this, of course, we've tried to source as much data as we can. We know we've got strong, really informative property market data here at CoreLogic. We wanted to look beyond that as well. So we looked internally and externally to give us a steer on which of those regions are looking better than others and where they're heading relative to each other. And I think a key thing is to look at that basic principle. We know that there's so much regulation and the market's been so shaken up by government and Reserve Bank around investment property. We really want to try and reflect, maybe we were going to see investment property not be as attractive in the future, and maybe some investors also looking to get out in the future. Maybe not desperately, but looking to list their property, take what they can get, and move out of the market as their costs are starting to increase. And the key thing we want to try and understand is if investors are trying to get out or other people are trying to sell, where might they not be able to be replaced by other investors because there's low yield, those increased costs are making it hard to do those sums. So that's where the CoreLogic data will come in, really strong, the property data that we've got, buyer classification data, of course. But we also wanted to understand externally, what else can we get from outside of CoreLogic to give us a feel for what's going on. And so I do have to acknowledge both Centrix and Trade Me Property, who really enabled us to get that broader and deeper understanding of owner and buyer activity. So I do want to say a big thank you to you both. And of course, we'll delve into the data we've actually got from these entities later on. And another key source before I move on from this slide is just to say Stats New Zealand economic data, of course, freely available, looking at employment growth and other local economy data as well, economic data, to understand what industries are really core to those different local industries within each area. So before we do get into the measures and then through the results, I think it's worth saying we're not going to be able to get into the nitty-gritty for every single area, every single city or town today. That can absolutely come later on or on request. What we're going to focus on today is the measures, the key findings from the work that we've done, and then focus on a few of the key centres, the big centres, a few centres of most interest because they're sitting at one or the other end of the scales. And I think that, any time we look regionally, in New Zealand, we get very parochial. We back our home provinces, none more so than in rugby, of course, but I suspect property sort of comes maybe second to that. And we'll bring out the same nature in many people. And I know that, many of you probably know that I'm based in Wellington, but I am a staunch Northland Taniwha supporter at heart. And I do defend and praise them at every opportunity. While Calvin, based in Christchurch, but he's probably what would come from the area of mid-Canterbury. And they're on the Mid-Heartland Championships. And I really enjoyed seeing over the weekend, of course, Sam Cane turning out for King Country. And that's probably one of the best things about our rugby in New Zealand is that really heartland feel and everyone really having that passion for the local area that they're from. So I will acknowledge that. I know that people are going to look at their area and go, oh, why do we score so badly? Or maybe be proud they score really well. Remember, it's all relative, and we're not saying that the forecast that things are going to go really well or up or down in one area. It's all relative terms. So with all that said, let's move in and let's actually look at some of the data or the measures that we've looked at to try and assess where things are at the moment. So we've got 6 essential measures that we've looked at, and I'm going to work through each of these ones. The first one is looking at housing unaffordability. So where things have maybe got really, really unaffordable and we can't see that being sustained. Recent credit behaviour, looking at the behaviour data from Centrix that we've managed to attain. So once again, thanks to them. And then, of course, those financials for investors. Where are we seeing areas where the investors just may not be able to make it stack up for them to continue to purchase in these areas? So I'm just going to work through each of these ones in a little bit of detail. Firstly, for housing unaffordability, as we've put here, it's really looking, we were seeing a sustained rate of growth over a long period of time, and it's just made property so unaffordable, and we can't see that being sustained, especially in areas where there maybe hasn't been the same population growth to really justify that growth in property prices, or employment growth as well, where people are obviously getting the same income growth at the same time as that property growth. So we're going to look at where that maybe has come out of whack with previous history. And the illustration of this really comes true when you look at a couple of the measures that we track for housing affordability, both the years to save a deposit, this is in arrears, and the share of income required to pay your mortgage back, which is in blue. Now, over the years, these have generally got better because interest rates have dropped. Now that we're in this environment of interest rates lifting, we're starting to see that turn for the worst. And you can see there, the years to save a deposit measure nationwide is, of course, the worst it's ever been, according to all the history that we've got going back here. Not only that, now those people that have previously seen things get better as interest rates drop, even if you already own a property, now things are becoming less affordable because you're going to see your mortgage payments increase, and that might have an impact to your disposable income as well. And of course, like everything we're going to talk about today, there is always going to be a regional difference here. And one of the key things that's really stuck out over the last 5 or 6 years has been across our main centres, the divergence between an area like Dunedin and the other main centres. And you can see that 5 or 6 years ago, that dark blue colour is Dunedin. 5 or 6 years ago, that was the most affordable of our main centres when you look at the years to saver deposit. But in the last 5 or 6 years, that's now tracked to become our third least affordable main centre across the country. And just shows how much things have changed within the regions as well. And that's, again, one of the things that's led us to get to where we are, and that's reflected in our measure today, looking at affordability. Moving on to our recent credit behaviour. As I said, getting hold of some Centrix data at that city or TA town level, really understanding what's happening from a credit perspective. Where are people who hold a mortgage, where are they maybe a larger proportion of them on interest-only lending, which might show there's more investors there, which may not be a problem, but does show that maybe there's some vulnerability from those investors who are only paying interest-only terms, and if they got shifted to principal and interest, might have an impact on their affordability, which may see them want to list their property. Also, where people are already start to see some problems with their payments and mortgage arrears, or financial hardship as well. So this data is really giving us an idea. Remember, there's an early indicator for people struggling to pay back their mortgage, which might lead them to in the future want to list their property for sale as well. And a couple of examples here, we are seeing slight tick up on this behaviour in both Mackenzie District and also Queenstown Lakes, which maybe not surprised given some of the problems that you can understand while the borders are closed and some of those businesses and people are struggling to pay back their debt. And then already spoken about this today in terms of the financials for investors. We've seen such increase in regulation for investors and it's starting to squeeze their profit margins, and some may want to sell. And the key thing we want to understand is, can they be replaced by other investors who want to buy that property in their place? And I think this is really clear when you look at some of the data we get from the Reserve Bank on the left-hand side here, where you can see the lift in investor activity, both in the last year, but over a long period of time, who have a relatively high LVR or a low deposit. And so the dark blue line here is looking at those investors that are borrowing with less than a 40% deposit, 60% LVR. And then the dashed blue line is looking at those with less than a 30% deposit. Of course, we know the LVR restrictions were temporarily removed last year. We saw investors take advantage of that, a greater share of lending go to that group. And now we've seen that drop back down considerably. Not just the less than 30% deposit, but less than 40% deposit. Now that from the 1st of May, investors require that amount of deposit to get into the market. And you can see that on the right-hand side, the impact of that 40% deposit requirement has on the share of sales to investors, where you can see in October 2016, the investor share with a mortgage drops quite considerably, about 4 or 5%. And again, we've seen that now where 24% of all sales in Q3 went to investors borrowing with a mortgage or buying with a mortgage, a considerable drop from where they were earlier this year when those LVR limits didn't exist. So I think it just shows there's going to be reduced demand as long as those LVR requirements are in place. And we know that there's more regulation coming as well, the discussion around a higher interest rate floor for serviceability testing and potentially even debt to income restrictions coming in at some stage in 2022 as well. So we know there's going to be a consistent handbrake, I suppose, on demand, especially for investors, and also flowing through to owner-occupiers now as well, with the reduced amount of lending banks can do to owner-occupiers with a small deposit or a high LVR. So regulation is here to stay. It's going to have a drag on demand, and that's where we think this is going to impact profitability and activity going forward for those investors as well. So that's the first three measures. The next three measures that we've looked at are really where we're starting to see a demand or supply rebalance. And so some of the things we're already starting to see in some centres, we're starting to see listings start to lift. So yes, we know we've been at all-time low levels for listings, but we are starting to see that change. The second one we're going to talk about today is where we're starting to see local employment or economy starting to show maybe some weakness coming up in the future. Areas that are really reliant on one industry, using that Stats New Zealand data, or one business in particular. A couple of examples there, of course, Kawerau Paper Mill, Tiwai Point down south, we know the discussion around that potentially shutting, and the fact that Taranaki Gas is going to be no more exploration or no new exploration permits given for that area, and the number of people and businesses that rely on that part of the industry. And then from a property demand perspective as well, using the Trade Me data, understanding how active are people looking at certain properties in certain areas, and how might that be changing over time. So if it's reducing or diminishing over time more so than other areas, we might understand some areas that may be seeing a draw in demand, and that might influence where property prices could go in the future. A couple of examples there we've seen in that Trade Me data, Stratford and Clutha, where we've seen a reduction in activity in those areas. So from demand and supply rebalance, this is really looking at where we're seeing these listings figures. Yes, we know we're at all-time low levels nationwide, And that left-hand side shows you just how few properties are listed for sale today compared to last year and the year before. Minor tick-ups, so we're starting to see things improve. And again, we do see regional differences. When you look at the year-on-year difference from our main centres, you can see there's some pretty big differences occurring here. Dunedin on the right-hand side, only slightly below the same time last year and the year before. Whereas in Auckland, Tauranga and Christchurch, listings today are 50% below where they were 2 years ago and about 40% where they were last year. So you can see there's some real differences here. And we're starting to see this change across different parts of the country. Where we start to see listings lift, maybe sales slow down, which means properties are staying on the market longer. That's really going to give us a feel for where there might be the switch in the market where you're starting to see it turn into a buyer's market more so than a seller's market. And maybe you're going to see that less price growth in the future. That's just looking at sales data, of course, where you're seeing that sales. And on the right-hand side, you can see sales in Dunedin. You can see even with the lockdown occurring in August, there was sales volumes starting to track back a little bit faster than that anyway, already waning. Tied into this, I suppose, is where property demand might be pulling back as well. So using that Trade Me Property data, the interaction on their website, people looking at property by TA, by city, by the different towns, and also adding to their watch list. So if people are looking at properties in Gisborne and they're adding to watch lists and that's starting to change, either increasing or decreasing, we can sort of use that as a vibe of what people are actually doing, interacting with those websites, with that website as well, as a sign for where people maybe are just saying properties are too expensive. Maybe they're going to start to reduce their activity on those websites as they start to lose a bit of faith that they can be active in those areas. And so that's one tied to that demand side of things as well. Very early indicator where we might see sales slow down. And the last one that we've looked at, of course, is probably, Calvin's specialty really, is understanding local employment and the economy in each of these areas. So where are those places over-reliant on one industry, or where have we not seen strong growth in employment in some of these areas? So the key thing, of course, since COVID hit our shores, February, March last year, we've seen growth in employment, not a decrease in employment, but it is different around the country. And so we were seeing really strong employment. That's a really strong base for future growth as well. Whereas we maybe haven't seen the same growth. Maybe it shows that the industries and areas that rely on that aren't so good for the future as well. And we know that some parts of the economy are still doing really well. Agri, of course, is doing okay. Manufacturing still doing good. So areas that rely on that shaping up a bit better than some of those areas that may be still quite reliant on international tourism, or, as I mentioned earlier, these areas that are over-reliant on one industry or one business, such as places like Kawerau, Tiwai Point. Now, across this, of course, not all these factors are going to be weighting equally. So we've really gone about a business to say, what do we think are going to be the strongest drivers in the next 3, 6, 12, maybe even longer, a couple of years' time, that are going to have the greatest influence on where property prices will go in the future. So we've weighted the greatest one, housing affordability. Where we've seen that diminishing affordability for properties, we expect that to have the greatest influence on where prices will go in the future, especially if it hasn't been backed with population growth and employment growth. Recent credit behaviour, where we are starting to see people struggling to pay their mortgages, that's probably a good early sign that maybe we won't be able to see that growth in the future because people can't afford to buy property, and maybe you'll see people be motivated to sell their property as well. So that's the second biggest influence. Our investor activity, so seeing we've seen a lift in investor activity recently that may not be able to be kept up with. Our demand-supply rebalance, where we're seeing listings start to lift and sales start to slow down. And local employment and economy, they're all about 15% weighting there. So about even weighting, chuck them all into the mix. And then the one at the other end is property demand. And I think because this is a really early indicator, but it can be influenced by a number of different factors, we've put that in at a 10% weighting to give us an early indicator, but maybe not quite as strong as something like the actual price of property in itself. And we chuck all this together and then give every single region a score. And that's where we get through to our results. So, what's everyone interested here? We're taking 20 odd minutes right now, but what are people interested in? I want to know where their area sits across the country. Now, when we look at this, just going to break it down very briefly by the North and the South Island. When you look at the North Island, the darker red colours are, of course, those areas that are showing up as the most vulnerable. The darker green are those that maybe look quite robust and least vulnerable to price drops in the future. The key ones that stick out in that North Island are the smaller centres. The size of these bubbles really indicates the size of these areas in terms of population and the amount of people that live in these areas, the population and number of properties in these areas. And they are the smaller areas, sort of in central part of North Island, Otorohanga, Ruapehu, Kaipara up north, Kawerau, which has already been mentioned today, Portakey and Tararua. So these smaller centres are really showing up as the most vulnerable. When we look at the South Island, the only one that really jumps out from a red, vulnerable perspective is Mackenzie District in that central part of South Island there, quite a, obviously heavy area for holiday homes. So that's one that jumps out. Of course, Queenstown's always one that's going to show up as interest. What really shows up here is some big clustering of green bubbles. And this is really in the northern part of the South Island, around that Tasman-Nelson area, and then that wider Canterbury region as well. We've got, even Tumaru, Waimakariri, Christchurch and Ashburton all showing up at that really far right-hand scale, the least vulnerable areas, quite robust markets. And we'll delve into the details of all this. Before I jump there, I'm going to have another drink myself and give myself a chance to have a breath. Here's the full scoring for everywhere across the country. So I'll give you a few seconds to maybe, lean forward, take a quick look and see where your area sits in this, and maybe pull out a few pieces of places of interest as we work through today's webinar as well. All right then, well, moving on, I'm going to delve into a few of the main centres first up. Just pick apart a few of the reasons why they score the way they do. You might have noticed that Auckland was one of those ones that were sitting towards the left of that sort of central vulnerability scale. And the key reasons here, housing affordability, which sounds crazy to score it green, but it's, I suppose, a good reminder, this is all relative. Everywhere has seen affordability diminish significantly over the last wee while. And Auckland in that scale or that context hasn't actually got much worse when you compare it to the rest of the country, probably because incomes have at least increased to a degree, and so it doesn't show up so bad on our relative scaling position for the affordability or for the vulnerability scale. Credit behaviour, we do have a relatively high proportion of mortgage holders that are on interest-only payments, which, as I say, it's not necessarily a bad thing on its own, but it could be an indicator of lots of investors holding here. And if we did see a shift towards people being forced to own or to go into principal and interest, that may start to see more people, requiring to sell their property. So it does show up on the scaling there. Investor activity has been relatively high when you compare it to recent activity, and so it's scoring a bit of a darker red on that one. Demand supply rebalance, look, low supply still, so we're not seeing an immediate change to that. We're still seeing very low supply. Sales volumes are relatively elevated considering they're in lockdown up in Auckland. Relatively solid economy, reasonable employment growth over the last year. We are seeing a reduction in the property demand, but again, it's probably a little bit of a caveat here, where demand after a while for being in lockdown does start to reduce. So it's probably affected by the fact that we've seen that longer lockdown in place in Auckland, and so we are seeing that occur when there's reduced property demand from Trade Me perspective. So it's scoring bad on that, but we've maybe got to put a little caveat on that one. Dropping down the state highway there to Hamilton, scores much better. Housing affordability is a little bit worse when you compare it to Auckland in terms of the scale. Credit behaviour, again, slightly higher in interest-only mortgages and credit activity, but really low arrears and low financial hardship. So certainly not one to be worried about. High on the investor activity though, and that's certainly something where we're paying close attention to, and really low yield for any new investor trying to get into the market there. So hard to see the attractiveness of that market continue for a long period of time due to that change. But again, demand-supply rebalance is a long way off. Very low listings, sales volumes remaining elevated, and so we're not seeing that change anytime soon. Very solid economy, strong employment growth in Hamilton as well, and pretty strong demand as well. So that's meaning it's not scoring quite as bad as some of the other areas across the country. One that scores quite well is Christchurch, and a big reason for this is very favourable affordability. Anytime we talk about affordability, Christchurch shows up as really strong. We haven't seen the same price growth, and the market there is actually looking really solid, especially in a nationwide context. Credit behaviours look pretty good. High credit activity, so people still asking for more credit, which isn't necessarily a bad thing. Average financial hardship and very low arrears, so scoring okay there. Consistent investor activity, so there's no problems from that perspective. Typical average yield, so not low yields, looking pretty good. Demand supply rebalance, still persistently low supply, so again, pretty consistent story across the country. broad-based economy with reasonable employment growth and consistent demand activity from trade me. So that really gives Christchurch that overall green score and looking pretty solid for a robust future for Christchurch in that future. But if we switch then to some most vulnerable markets, so some of those areas that were showing up at the left-hand side of the scale, a bit red in terms of our vulnerability. First one we're going to talk about is Aotearoa. Significant deterioration in affordability here. So as I said, across the country we've seen deterioration in affordability, but some of these smaller areas we see it even worse, and income just has not been able to keep up with price growth in these areas. We're seeing relatively consistent listings, so it's not quite as bad as we've seen in other parts of the country, and we are starting to see demand activity start to slow down as well, so potentially that switch to a buyer's market coming soon. Has had relatively high investor activity as well, and so that maybe does show that if that can't be kept up with, demand will reduce and you will see prices start to at least plateau. And then when you look at that credit data, also some things to be considerate of that we are seeing a relatively high, and this is from a small base of course, a relatively high financial hardship and credit arrears starting to show up in a place like Aotearoa as well. So that's the reason it's really sitting at that vulnerability end of the scale. Ruapehu also starting to show up at that end, listings starting to increase, we're seeing sales volumes slow down, affordability again is a key component of this, and we are seeing demand activity reduce. Probably worth recognising a typical holiday home area, and maybe that just shows that when we do go through a slowing market, holiday home areas, people don't have the same disposable income, and we see these holiday home areas start to slow down. Doesn't necessarily mean prices will reduce, just means maybe people won't sell their property if they can't get the price they want to. So that's certainly one thing to keep in mind for a place like Ruapehu. Down south in the South Island, Mackenzie, we've already talked about it quite a bit, but looking into a bit more of the detail, relatively high mortgage arrears and financial hardship, high inventory, so we are seeing a large number of properties listed for sale compared to the rate of sales that are occurring right now. Again, with everywhere else, deterioration in affordability, we have seen increased investor activity, again, maybe holiday home purchases, so we need to be cautious of that, and fewer people overall in employment in this area, which again just shows that it's more of a holiday home area than maybe a typical investment property home area. Queenstown Lakes, you almost can't get away, I think. While our borders are shut, we know it's the most reliant, I suppose, on international tourism. Done okay throughout the last 18 months, of course, and it's shown it's got very resilient market despite the borders being shut, with relatively strong growth in the property market over the last wee while. And one thing I always say around Queenstown is that no matter what happens in the market, the beauty of a place like that is never going to change, and that's going to cause people to continue to be attracted to buying property there if they're looking long term and know that they've got a long term hold period, and they know that people are going to want to go to Queenstown either short or long term, and that will mean that there's always going to be a decent floor underneath property prices for a place like Queenstown. But we do have to be considerate of the fact that employment has been dropping. We do have a relatively high percentage of people on interest-only lending, probably keeping their expenses down as much as possible, and credit activity has remained relatively high as well. So that's a couple of the main areas, I suppose, for vulnerability. The other thing I suppose we wanted to do before we open this up to questions and work through some of those Q&A that we've got, is to just look at a couple of the other main urban areas that we often pay a lot of attention to. They're relatively high population bases, and I'll just focus on some at the vulnerable end and then some of those at the least vulnerable end, because maybe some of the reasons why they sit where they do will be of interest or certainly be of surprise to some people as well. So firstly, those that are sitting at the the more vulnerable end of the scale, Taupō, Rotorua here as well showing up. For Taupō, we are seeing a bit of a swing in those sales volumes and listings show up, and that's probably one of the key reasons it's sitting at that vulnerable end of the scale. For both Lower Hutt and Palmerston North, affordability has deteriorated more so than the rest of the country, and we're also seeing heightened investor activity that we don't think can be sustained, and that's why they're showing up at the more vulnerable end of the scale. While Rotorua, similar to Taupō in terms of being a holiday area, but also we're seeing demand reduce now, and also that reliance on international tourism starting to show through with the reliance from a local economy perspective as well, which means it's showing into that more vulnerable end of the scale than otherwise. At the other end, a few of the areas, we've almost got the north, west, east, and south of the country showing up here, but that sort of main urban area, second tier below those main centres, the areas that are showing up and why they're actually looking okay, or maybe some of the areas to be aware of even though they look relatively good. Invercargill, one down south, of course, relatively low concerns from credit. but we are seeing a demand and supply switch very slowly. So we're starting to see demand demand slow down and supply start to lift. So maybe the early stages of that switching to a buyer's market, and that'll mean that there's price growth in the future. From New Plymouth, actually, all the markers underneath, all the measures that we're looking at, pretty solid across the board. But of course, we are aware of the economy there, the reliance on the gas industry. But that's been in play for a wee while now, and it's continuing to show relatively robust. So it probably shows that it's not overly reliant, and also shows that it's got a significant reliance on agriculture, which is actually showing up pretty well at the moment from a broader economy perspective. Whangarei, of course, where I'm from, there are some considerations for what's happening from a credit perspective and a larger proportion of investor purchases, but otherwise, according to all the other measures, looking pretty solid. And then, of course, Hastings on the right-hand side here does have strong demand at the moment, so holding up relatively well, but just beware of what's contributing to the local economy there. How is employment going? What's the future of that looking like for people in the future as well? Okay, when your video showed up again, I'm going to ask and see if there's any chance you've got a chance to join in at the moment, or are we still having some troubles down there with Christchurch Fibre or something? Looks like no luck, so I'll continue to push on through. Look, I'm pretty much going to close that out for today. I think, just wanted to close out by talking about how do we see this being used. And I think that what I wanted to do was talk about, we think it'll differ. We hope this will help to inform any market participant, depending on your role, whether you're an agent, whether you're a valuer, whether you're a banker or an advisor. People are going to take different things from this, so it is going to differ across the country. I think that overall, or certainly the way that we'll use this, we'll be looking at to say, you may want to use more caution be applied in certain areas than otherwise. And the upshot, of course, being that if you're acting in a local area, it always pays to understand that better. I'm not going to be able to tell you about what's going on for local employment in a smaller area that maybe, gets filtered out from some of the data. Understanding your local area is absolutely key to when you're trying to advise anyone that's active in a certain market. Perhaps you want to show more caution in those areas, but the key thing is, as a researcher, of course, do your own research, understand these markets, where they're more vulnerable or where we're showing them as being potentially more vulnerable. Make sure you're understanding what's going on, what's beneath that, and being sure that you're comfortable and confident of a price that might be achieved for a property. Again, I want to reiterate the point, we are not aiming to forecast each area where the market's going to go to in the future. It's about relative performance over a short to medium period of time. Show those areas that might perform better or worse amidst our overall expectations, which are the market continuing to slow down through the rest of this year into 2022 and probably even the next year after that, that it's not going to be all one size fits all. We're going to see differences emerge across the country. So understanding those differences as to why they might occur is really crucial, and data plays a big part of that. Of course, where to from here, we know that a lot of these measures we're tracking are changing regularly. We're getting weekly data on listings, on sales volumes and values. We'll be tracking that on a weekly, monthly basis. We'll be updating all of our data and tracking where this might be changing, where we're going to see some areas move from one end of the scale to the other relatively quickly that we might want to pay more attention to. So we'll certainly be paying close attention to that. In terms of what it means from an external perspective, we'll be tracking it regularly ourselves, talking to each of you who are our clients about any significant shifts which you might want to be aware of, and then maybe updating the actual final report once every 6 months or so. So certainly keep an eye out for that in terms of an external view of this, but we'll be updating the underlying data on a regular basis anyway. And of course, do feel free to get in touch with us following the webinar today. If you have more questions, if you want to find out more about what's in it, or really get into some of the nitty-gritty about specific insights to certain areas that you might be really exposed to. If you've got a lot of lending, or of course you value, or you're an agent in a certain area, you want to understand more about why we score an area a certain way we do, please do take that time to get in touch with us. We're more than happy to spend that time working through the detail on that one. So I'm going to scan through some of the questions and answers that have come through today. Of course, I've left our details there to get in touch with us following the webinar or at any stage. And I'll see what sort of questions have popped up here. So bear with me as I try and track through those. Maybe Calvin I can see on a chat within internal, so maybe he can feed me through some of them as well. But keen to see if we've got any information here. So see some good information here just feeding into the insight that we've provided. So thanks very much for letting us know about that. Where are our chats? Has infill housing in Auckland been taken into consideration when assessing demand, given Auckland consents are at record highs, which may lead to a significant uptake in available homes, curbing supply issues? Yeah, look, we do recognise that new homes do make up a big part of Auckland, more so than the rest of the country. And so we do try and take that into account with all our measures. Trade Me, of course, from a demand perspective, does have a category you can look at just new properties. And so that will still be a factor for them. So taking into account all people, looking at all property within Trade Me's listed properties, whether that's new or existing properties. So it will be taken into account for the overall demand perspective from that. From a sales perspective, yeah, we get sales for all property types, whether they're new or otherwise, although of course some new properties take a while to flow through the data, depending on if they're off the market sales or on market sales, off-plan sales, or on-plan sales. So they will be intertwined within this, and certainly something we're very aware of when taking into account assessing Auckland market in general. Of course, do want to plug our podcast as well. Calvin and I do a weekly podcast where we talk about, on a weekly basis, different data and information that's coming out, and I'm sure we'll talk a little bit about today as well. But do go subscribe to our Property Market Podcast. We come out every Monday afternoon, recorded every Monday morning, just to give you an insight as to what's going on with the most recent data as well. So please do take the time to go and check that out if you're a podcast listener, on your local commute, or potentially on your local run, which is certainly when I listen to my ones. I'm just picking and choosing things as I can see them, so I do apologise if I do miss some questions today. Rupert, thanks. The Reserve Bank has been incorrect with their house price predictions in recent times. How much confidence can we have in their prediction of negative value growth in the coming years? Yeah, look, a fair point. I don't think it's just the Reserve Bank who are forecasting slower growth in the future. I think it's fair to have scepticism about whether it drops into the negatives, and we certainly probably don't expect that to happen nationwide. But I do think that the overall theme of a slowdown certainly aligns with our expectations. So while we wouldn't exactly pin our predictions ourselves to the fact that Reserve Bank say 0% growth by the end of next year and dropping into negative 3 or 4, middle of 2023, I think the overall idea is consistent with our expectation, and that's where we start to then overlay our expectation of what's going to happen from a regional perspective. So I think it's right to be sceptical of these. Reserve Bank, ourselves, many other economists have obviously been wrong many times in terms of where we expect property prices to go, and so we don't expect it to, we don't pin a forecast for this either. That's why we're looking at general terms as to where we expect the market to go and where it might fare better or worse than other areas. So yeah, good point, and thanks for picking that one out. Ravi, has the inland port been built in Hamilton, has been taken into consideration for this data? Not really. I suppose the local economy to some degree might take that into account, but probably from a broader perspective, we're only looking at the data that's feeding through Stats New Zealand that shows how solid economies are and where they're likely to go to in the future. But really specific things like that probably don't flow through in the data. It probably takes a bit of manual intervention from us to keep that in mind, that the employment considerations for the future are really strong, where you see things like that, the inland port for Hamilton, other areas which we know, Wellington, for instance, strong government base, that means it fares quite well. Other areas where we know there's strong growth or potential growth in employment, we'll certainly take that into account in our scoring system, but so far that one probably won't have. And that's where I think that local knowledge, that local insight is really important. If you're an investor buying a property, or you're someone that is advising an investor and they're going to buy in Hamilton, knowing the fact there's going to be strong employment growth, which might give you a solid base of potential tenants for future, will obviously be really key local employment or local knowledge to impart on those people who are likely to be active in the future. So that's a really good point, and one that local knowledge shows is really key. Any data around people leaving Auckland and settling to other regions? Yes, we do. Manju, thanks for that question. We haven't included it in any of our measures for this vulnerability index. We looked at it in the past, and what we have found in the past is that people overestimate the amount of Aucklanders leaving Auckland and going and settling in other areas. We can only see whether they've sold a property in Auckland and then moved to a different area, or potentially they've got a large amount of investment properties in Auckland and they've then made their way down the state highway to Hamilton to increase their portfolio, and we see them buy an investment property in Hamilton, on top of maybe 3 or 4 properties they already own in Auckland. So if there's a property purchase among that shift, we can certainly see that change. And we have seen there's times where I think upwards of 18% of sales in Tauranga in one quarter a few years ago were from Auckland, people moving to the area or investing in the area, but it's not as strong around the rest of the country. So while you might hear anecdotes and you'll see a newspaper article, which of course can find one Aucklander that bought in Napier or bought in Nelson or bought in Queenstown, there's always going to be occasions of Aucklanders and other Wellingtonians and otherwise going and buying in the regional centres, but we haven't seen a massive uplift in many times over history or in many places other than places like Hamilton for investment and Tauranga from a moving perspective. And we do expect that many people probably retiring and cashing out of the Auckland market, buying a smaller or at least a more affordable property in Tauranga and taking a bit of cash with them at the same time. So we have seen that in the past. We can certainly put more data around it, and there's probably a few articles already seen on our website which we can check into at some stage as well. Bear with me as I scroll through a few more questions. Immigration from Joe. How will recent New Zealand immigration policy change for work visa to gain New Zealand residency affect the future market? Look, immigration, population growth, of course, is a factor on demand. People need a place to stay, so it is a factor. I think what we've seen, especially in the last year, but probably even over a long period of time, the key determinant to property prices, or one of the most important ones, is credit availability, is the amount of lending that's being done. Yes, of course, population growth, the amount of people coming into the country is always going to be a factor. But I think what we've seen most recently is that actually what's really determinant is what's happening from a credit perspective. How easy can you get credit from your bank? And that's determined by interest rates, which we've seen drop more and more over the last wee while, as well as things like deposit requirements. And you can see that when the LVR limits were temporarily removed last year, you saw massive credit growth of people who then went, cool, I can now buy property when I previously couldn't. So I will go and buy a property, the first one, or maybe an investment property. So I think the immigration policies we'll certainly pay attention to, but it's probably tweaks around the edges, as opposed to being a massive determinant on where property prices are likely to go to the future. When you compare to previous, what did we get? 70, 80,000 annual growth in net migration prior to the pandemic hitting New Zealand. We're not likely to get back to that level in the future. The government's talked about tightening settings. So I don't think we're going to get to that same level. Yes, in the short term, we might see a bit of a lift, as we know there's some temporary visas that will be extended. So we might see a little bit of a bump from that perspective. But overall, I would say we pay attention to it, but it's not a key determinant. So we won't certainly see it as a big factor as much as increasing interest rates or what's happening from a Reserve Bank perspective from maybe debt to income changes, ratio changes, and LVR requirements. Has a report been made available to the public? It will be as soon as this webinar finishes today. And so that'll be available to anyone that's attended or signed up today. That'll be sent out. So thanks, Alexa, for sending that one in. Stephen, thank you for your feedback. Shang, immigration, I think we've talked about that. I don't think we've got a very good feel for where immigration might go to more than others. It's probably a factor of economy, local economies. So I think we do see a large proportion of people that move to New Zealand, net migration, a larger proportion go to Auckland. So when we do see migration start to open back up, maybe we see a bit of a boost to Auckland's property market, more so than some of the smaller centres, which we know don't attract the same international migrants that local migrants do go to. So potentially that's one thing to look out for. But as I mentioned, it's probably not as key a factor as we've seen in the past. Sean, do we think the OCR would be a sole driver of house price? Not the sole, but a key determinant, certainly. What about land building costs, which would be built up by factors beyond Reserve Bank's hands? Look, no doubt. Cost to build has been increasing significantly and only like to increase further. We know there's capacity constraints in the market, both from a labour market perspective, but also from materials. And with supply chain still influenced by COVID, both here and around the world, we know that's only going to get worse in the short term as well. It's very hard to find a builder, and then the costs are just increasing at a significant rate. I think we saw some data come out just yesterday around the cost of steel, and it was already coming on the cost of timber previously. So this is here for a while, and you're right, the Reserve Bank have no way of influencing that. And the interesting thing is, of course, with the government changes around interest deductibility, LVR requirements, they all have exemptions for new build. So we're pushing even more demand towards new build, an area that we know is going very strong. We're seeing very strong consenting figures, but is really close to being at capacity, if not already there. So how the market reacts, that's going to be really interesting. And potentially, one of the things the government needs to look at is how can they actually start to influence the cost to build? Can they subsidise, the cost to build so that they're actually helping to build more properties faster and bringing that cost down so it's not all passed on through builders, through developers, and through that end buyer as well. So maybe that's an area where funding needs to get shoveled from a government perspective as well, not just in helping buyers into the market, but actually reducing the cost to build. So maybe that's one thing we can might see from the government in the future. So we see large build-to-rent organisations being significant in New Zealand in the future. Look, it's certainly an area that's changing significantly. We're only sort of finding more and more out about this. There's certainly an area that's being led to be offering, I suppose, more exemptions as well. Much like we see exemptions for new builds in general, build-to-rent is certainly an area that is being more and more information, more and more pressure, and more likelihood of that being a bigger part of the market. In the short term, we're not going to see a dramatic change, I don't think, so the influence will be longer term, but certainly in the short term, good to see some mindset changing, good to see some influence, good to see, the central government starting to listen and look at this and understand how they can assist build to rent, because there's no doubt we need to change the way that we see property and that we enable property to be built, and build to rent is a key part of that. And the other one is shared ownership schemes. Over the weekend, we saw the government announce their shared ownership scheme. It's pretty small, less than 1,000 properties likely to be involved in that scheme in the first 3 years. So it wouldn't be a massive market determinant, but certainly looking to help out those people that otherwise cannot get into the market because they can't hit deposit requirements or they can't hit the average value of property these days. And so they should look to be helped out. So it's really about trying to reduce that inequality, but not going to be a massive market determinant for the next 3 years anyway, because it's going to be relatively small in comparison to the overall market. That was from Tim, so thanks, mate. Yes, there'll be a recording of this as well in the future. Yep, I know we always throw a lot of information and data out at you, so you'll be able to watch back at any stage to really take it in later on. Infill housing, Wesley, I think we spoke about that one too. Thanks for your question. Well, thanks. Questions answered. Lifestyle properties performed differently to other residential. Look, I haven't looked specifically recently. One thing we have seen is that, since the pandemic, all properties except for apartments have performed really well. I think the apartment market's still been held back by the fact that a significant proportion of demand for apartments is from international students and also Airbnb as well, so people who have their own short-term accommodation. Those are two areas that, of course, have been impacted short-term. So demand hasn't quite been there, and we haven't seen the same growth in the apartment market as we have for, normal houses or houses on a section, and lifestyle's also been included in that as well, but probably not quite to the level that you might have thought, or maybe some of the newspapers would cover, where apparently every single person is now moving out to the WAPs, lifestyle property, and never moving back, never going back into main centres for the office. It probably hasn't quite gone as far as maybe we've been led to believe, but certainly lifestyle's been an area that's performed quite well in the last 18 months, certainly when you compare to apartments. Thanks, Jeremy. Karen, I think we talked about updating. Health demonstrated by Canterbury. Canterbury prices start to catch up. You've already seen a bit of a Canterbury prices start to catch up. I think the thing we need to be cautious with in the broader Canterbury region is that we have seen a significant growth in the number of properties across the broader region. And so we talk about this catch-up occurring, but actually because we've seen a massive influx of properties, properties being built, not just in Christchurch itself, of course, but in that broader Waimak, Selwyn region, that's maybe part of the reason why we haven't seen the growth in the market. And unless we see a significant increase in population to further see the need for prices to grow, and we see more businesses start to base themselves and have offices out of Christchurch, we may not necessarily see things catch up as much as maybe some people expect in that Canterbury region. So I do think we need to go, just because it hasn't gone through a growth phase, doesn't mean that it has to go through it, just because Wellington and Auckland have. Those Auckland and Wellington have a significant constraint on land, whereas Canterbury just has not had that. And with the earthquakes, we saw essentially a temporary scrapping of the RMA, and that led to the enablement of building and building quickly. And we've seen the growth in properties, the number of properties in that area, much greater than anywhere across the country as well. And that's a reason we've seen prices, I suppose, sustained or capped a little bit, not necessarily just because prices have been cheap or whatever. So certainly I expect a bit of price growth. There's certainly attractiveness for both investors and first home buyers over that short to medium term, but you still need people to live in those properties. And so again, it's about understanding what's happening from an economy perspective. Are people living, working there? There's still significant growth in construction there from a commercial perspective. The stadium's going to be built there. As more and more of these things happen, more and more people will see it as an attractive place. And yes, you may start to see some catch up, but do not expect it to catch up to maybe the same level. It may happen, but I certainly wouldn't pin my hat on it catching up to the same levels that we've seen both Wellington and Auckland get to, because it's just not as constrained with supply over the last wee while that we've seen in a place like Canterbury. Scanning through, I think we've got through most of the questions. We've got 4 minutes. I'll continue to just scan through and see what else we can see. Yep, all the information will be emailed out, and if not, then please do get in touch. Hastings strong, Napier not mentioned as strong. Good question. I'll need to just look into the detail a bit. I do have a spreadsheet in front of me, which is going to be a nightmare if I try and go through that at the same time as talking to you. I'll tell you what I can do. I can probably give you some very high level differences. Affordability, Napier's slightly worse, and also Napier's had a slightly higher proportion of investment activity, which is leading it to score slightly worse than Hastings has. And also trade me activity is much better in Hastings than it has been in Napier. So that's very high level. I want to get into the detail a bit more than that to understand why each of those specific measures score the way they do. But at a very high level, those are the couple of things that stand out to me where Napier just hasn't quite scored as well as Hastings, and why it shows up a little bit worse in the overall score. Property prices per Warkworth. We haven't gone down to that detail in the report itself. That's something we'd need to look into in a bit more detail following the webinar today. Term East Coast of Kaipara seems active as far as development is concerned, as areas such as Mangawai. Yeah, good point. I mean, again, very specific detail there, and something that's probably, again, we're not going to be able to get from the data we've accumulated today. It's probably about understanding a bit more of that, more granular, what's happening in property prices, volumes, properties listed for sale. These areas are going to be impacted by holiday homes as well, so there's a lot of detail to probably get into there, and something we can pick up on in a future date. Planning zones affecting vulnerability in rural areas. Good question, Adrian. One I cannot answer today either. Planning zones generally is taken into account with prices, so I hope that it somehow is accounted for, but I can't speak specifically for Southland. I know that it's certainly accounted for in Auckland. Unitary's planning changing there. Wellington's going through that same process. Typically it's reflected in the values that we see. So I'd hope so, but I don't know enough about that specific area to comment any further, I'm afraid. Range of acceptable yields, Gerard. Look, essentially it's relative to each other. So I think the Auckland average yield is about 2.3%, whereas in Christchurch, I'm not sure where it's at, maybe 4, maybe upwards of 4%. And those would be, examples of those at different ends of the scale. Again, it's all relative. If you're at that lower end, you're going to score worse in our overall investment attractiveness. If you're a higher end, you're going to score better, but it's all relative. 1 minute to go. There's a few more questions about some specifics here, which I'm not going to be able to get into today. And as I said, you hopefully can pull out some of that detail from the report. If not, please do feel free to get in touch. We are happy to take a bit of time to talk about some of the specific scoring and behind this. Prediction for sales volumes, next 1 to 2 years, Andrew. Look, we're expecting sales volumes to slow down. We just think unaffordability, increasing interest rates, attractiveness from investors is all slowing down. It's going to weigh on sales. And then likely we'll see properties stay on the market longer, and we'll see listings start to lift over that same period of time too. So 1 to 2 years, certainly expecting sales to slow down and listings start to lift. One last question, John McCarthy. What areas in New Zealand have been traditionally holiday areas? You've seen an increase in people wanting to move and live there. I think it hasn't changed too much. I think we're seeing the central parts of the North Island, Mackenzie and the South Island as well. Queenstown does not change. It's the typical areas that we've seen. Thames Coromandel has not changed. Even parts of Tauranga and the Bay of Plenty area as well. It's all these areas, typical holiday reasons, parts of the north as well, above Auckland. it's all these same areas that we've seen in the past. They haven't really changed too much. So we don't really have a measure of a holiday area necessarily, but it's the way that we see the activity of what we might call a multiple property owner that doesn't look like a typical investor as well. So that's the sort of things we look for. Hasn't changed too much, but something we can maybe look at in the future time. Perfect. All right. I'm going to say thank you very much. Please do subscribe to the podcast. Make sure you subscribe to our newsletters, which are out on a regular basis as well. Please do get in touch. Available, as I said, LinkedIn, Twitter, email addresses are all right there as well. My apologies for the fact that we couldn't have Calvin today and you only got to listen to me. But I do want to thank you so much for bearing with us. New platform for us. Great to have such amazing attendance. I've really enjoyed doing this live and hope that we can do similar ones in the future too. So thanks very much again. Please do get in touch, and I'll say see you later for now. See you guys. Bye.